All right, greetings everyone. This is Eric, founder and CEO of Cubicle Investing. Definitely visit the new website. That's right, we have given the website a facelift, so definitely check out cubicleinvesting.com. And there you can download my free ebook that will teach you the basics of how to trade options. And also, if you download the free ebook, you will start to receive my weekly newsletter called the Cubicle Weekly Reader that comes out every Monday at 10 a.m. Eastern Standard Time. All right, so today is January 3rd, 2023, right? And so this morning, when the market opened, and the underlying that I'm looking at, and that I primarily trade, although it's not the only underlying that I trade, but it's the one that I've been focusing on for the last 6 to 8 months, is the SPX. So I've been trading the SPX 0 DTE. And so when the market opened this morning, first 15 minutes, it was on a, let me just pull out my pointer here. Hey, got that. I'm just trying to pull out my pointer here, guys. Give me a second. All right. Bam, there we go. All right, so the first 15 minutes, the market was on an uptrend. And also looking at the advancing declining indicator, it was close to 2,000. So if we look at, as you can see here, the high was 1925. So that's extremely bullish. So I was under the impression that the market, considering that the advanced declining indicator was close to 2,000, that the market would be in an uptrend for the entire day. However, as we can see here, the market did pull back. Nevertheless, I thought that pullback was actually temporary. And so I got in on the put side at around 10:05, right? So roughly here. When the advanced declining indicator was at around between 1125 and 1265. Okay, so I got into a vertical put credit spread, and I sold the 37.90, and I bought the 37.85 to create a spread. However, so that was around roughly 10:05, around 12:21. And so right now the time is 3:34 p.m. Eastern Standard Time. So around 12 o'clock, the price of SPX got to about 3,800. So considering that my vertical put credit spread was at 37.90 and 37.85, that was a little too close for my comfort level. So what I decided to do was, I decided to put on a vertical call credit spread, and I sold the 38.70 and I bought the 38.75 to take in, basically to create an iron condor. However, I decided to roll out the vertical put credit spread that was due to expire today, and I rolled that out for tomorrow's expiration of January 4th, and I rolled it down to 37.70 and 37.65. And as you can see here, had I held on, I would have been okay, because the price of SPX has actually bounced and gone back up. So it's at 38.24 right now. So had I stayed at 37.90 and 37.85, I would have been fine. But nevertheless, you gotta trade according to what the market shows you. You know, so not what you think, but trade what you see. So because I saw that the market was actually declining, I figured that, I'm on the put side. I'm much more inclined to roll on the put side versus the call side, because why? The market goes up more than it goes down. So I feel much more comfortable rolling a vertical put credit spread versus rolling a vertical call credit spread. And I'm actually, I think it's a high probability roll, because considering that the market is down, it's slightly down today, although there is some noteworthy news that comes out tomorrow, but it's not until later in the afternoon, where the Federal Reserve will be releasing their FOMC meeting minutes that took place in December. You know, so that could cause, you know, some volatility. However, you know, I don't think that the market is going to fall below my strike prices of 37.70 and 37.65. The other thing I think, and so the other thing I wanted to mention too is that this year I'm really going to be consistent with screen capturing the price action that corresponds to all of my trades. You know, so for example here, you know, I have, you know, certain levels that I have marked off, and then as you can see here, these dotted lines represent the positions that I'm currently in. Right, so I have my resistance levels and my support levels, and so just, you know, being able, you know, so screen capturing your trades, the price action for the entire day that corresponds to whatever trade that you put on. I think it's a very good a tool to have at your disposal, because you can go back and reference, for example, you know, how a particular underlying, in this case the SPX, how it acted versus, you know, looking at some of the indicators that you guys may use to help you with your trading. So the primary indicator that I look at primarily is the advanced declining indicator for the NYC. You know, so that helps me to determine, you know, which direction or which side of the market I need to be on, whether it be the call side or the put side. You know, and so being able to, you know, have a screen capture of the advanced declining indicator along with the up and down volume as well, and then also having a screen capture of the actual price action for the underlying, I think it's very helpful, and it has helped me in the past with being able to see patterns, right? See patterns as they manifest. And so it's just a good way of helping you, you know, make trading decisions with respect to, you know, whether or not you should stay in a position, stay in a vertical spread, or whether or not you should actually roll that spread out based upon what you have seen in the past from, you know, reviewing your screen captures from the price action. You know, so that's something I'm going to be much more consistent with this year in 2023. But nevertheless, you know, whatever, and also journaling as well. I think journaling is extremely important. You know, being able to, you know, at the end of the trading day, being able to sit down and write out, you know, some of your thoughts and some of the things that you did wrong, and also the things that you did correctly. You know, so definitely journaling and also screen capturing. It's going to be something I'm going to really be doing much more consistently this year versus last year. All right, so we got roughly 20 minutes before the market closes, so it's 3:39. So the next segment of this video would actually be the next day. I'm going to show you guys how the trade went with this vertical put credit spread that I rolled from today's expiration out to January the 4th, which is tomorrow. So hopefully I'll be able to walk away with the entire $616, which I think I will. But nevertheless, stay tuned so you guys can see how this vertical put spread actually panned out. All right, so I'm back. So today is January the 4th. It's approximately 10:48 a.m. Eastern Standard Time. So I've actually already closed out the put credit spread that I rolled from yesterday. So if you guys recall, I rolled it to 37.70 and 37.65. I'll bring up a screenshot of the actual trade. So this here's the actual trade that I had on. So this was the trade that I rolled from yesterday. I rolled it from 37.90, 37.85 down to 37.70 and 37.65. And as I mentioned before, I'm much more inclined, or I feel much more comfortable rolling a put credit spread versus a call credit spread, because the market goes up more than it goes down. And so I was able to close this trade out this morning at approximately 10:01 a.m. Right? So, and the profit was, give me a second here, things popping up. All right, so yeah, so here is the credit. So the credit for just that rolled vertical put credit spread was 476. If you recall, the in the previous video segment, the entire credit for the vertical put spread and also the vertical call spread was 616. Since the vertical call spread expired yesterday on January 3rd, and I'm only left with the vertical put spread, the credit for that is 476. So because I closed it out early, I didn't want to stay in the trade the entire day, because the Fed is going to be releasing its minutes from its FOMC meeting that took place this past December. So, you know, no telling how the market may respond based on that news. So I decided to close it out early, and so I walked away with $388. So again, much more inclined to roll a put spread versus a call spread, because again, the market goes up more than it goes down. And considering that we had a down day yesterday, I had a feeling that the market would actually pop today. So we look at where the market currently is now. So it got up as high as, look at the, so it got up as high as 38.55. So now, as you can see here, it's come down 15 points or so. And so had I stayed in the trade, of course, at least at this point, I would still be good. But considering that there's going to be some news coming out later on today, I didn't want to risk it. So yeah, I closed it out, walked away with a profit, and so yeah, you know, it's basically move on to the next trade.